Schwab is laying off 600 employees amid a hit from the Fed's interest rates cuts. Now, normally I don't get too involved in this kind of stuff because if companies come and go, they lay off people all the time, and it sucks. No other way around that. But I worked at Schwab a long time ago for about 8 months, and I left right before they laid off people. And if memory serves, that was the first time they ever laid off people. That was in 2000. And I got, I have friends over there. For a lot of guys from USA went over there. Some weren't my friends, but others were. And I've always been a fan of Charles Schwab, the man, and what he's done for the industry for sure. Because Jimmy Carter deregulated commissions. That's fact. Jimmy Carter deregulated fixed commissions. And Ted Kennedy, if you can believe that, got in also to deregulate trucking, overseas trucking and airplanes too. It's nuts when you think about Carter and Kennedy. Nuts. But anyway, this bothers me a little bit. Anytime you hear about people being laid off, it sucks. And then you hear about people being laid off in a company that used to work for, and I don't know who it's going to be, but they're laying off 3% of their workforce. I just find that's a lot of people. 600 people are going to get laid off, 3% of their workforce. The reduction comes amid pressure on net interest revenue attributable to falling interest rates. Now, I'm telling you right now, NIA, net interest income, that is a bank's, that's the bloodline for a bank, net interest income. When I was a branch manager at First Citizens Bank and we'd have our P&L, profit and loss statement, I'm telling you right now, the two biggest drivers of profitability was net interest income, the amount of money we're getting out from the loans we're giving to people, and then, believe it or not, non-sufficient charges, NSF, non-sufficient fund charges, bounce check fees. It was crazy. Net interest income buzzed by far and away. Because a bank gets paid to lend out money. That's a fact. And if we're lending out, if we're having a hard time lending out money, going back to my man Richard Kuh's book, The Holy Grail of Macroeconomics, talk about the Japanese recession, and B, we're not getting paid very well on the amount we're lending. That's a bad thing for banks for sure. Net interest income, if that is dwindling, that's not good. Because remember, the biggest cost to an employer is the employee. So you got NIA dropping, and then you got on top of that, labor costs are not dropping the same thing. So the only way to reduce labor costs is to fire people. There's just no other way around that. That's not good. And the insurance companies going through the same thing. Insurance companies got all this money. So remember, let me give you an example. For a bank has a liability as the deposits they have. Believe it or not, that is a liability. An asset is a loan that they make, right? So, literally, if they loan you, Navy Fed, no, I have PenFed is my mortgagee, or they're my mortgage company now, PenFed. They have an asset on the hook for whatever it costs for me for this home I have. If I dump $100,000 at a CD at PenFed, that's a liability. They are obligated to pay me back that CD with interest. That is a liability, all right? I, on the other hand, have a liability to them. I am obligated to pay back this mortgage with interest. So banks have an asset in a loan and a liability in a CD. You got to kind of think about it differently. It's counterintuitive when you think about it from the bank's perspective. So if those loans are not growing, or if they're being paid down, the assets are being reduced, or they can't make more loans to increase their assets. And on top of that, they're getting more and more liabilities in the terms of CDs and cash. That's not a good. That's bad. That's bad for the bank. It's bad for the overall economy too when you factor in just basic velocity of money and whatnot. So a bank has every incentive now to increase their assets by lending out more money, which inherently decreases their liabilities as the cash that they have on the sideline. It's not sitting in a vault. It's just a computer thing. But they say we got $1 million in cash. That's a liability. We have to pay interest, and we owe that to somebody. We want to get that off our liabilities and put it on the assets by lending it out as an asset and getting interest on that, i.e. net interest income. It's very interesting. So let's keep reading. The cuts represent about 3% of the workforce and comes across all sectors amid an effort to streamline expenses as net interest income comes under pressure. This spring, we initiated a process to review our expense base to ensure we remain well positioned to serve clients while navigating an increasingly challenging environment, the company said. As part of that process, we have decided to eliminate approximately 600 positions across the firm. In Impacted positions span all staffing grades as well across the organization's locations. Rates have been falling amid worries about slowing U.S. economy, economic activity both globally and in the U.S. A company source said the staff reductions are a direct result by declining rates, which hurt banks by narrowing the margin between loans and deposits, just like I told you about. You got your assets paying you 3%. You got your deposits, your liabilities, you're paying 1%. As the assets are falling because loans gets paid and they can't loan out at 3%, they got to loan lower and lower and lower. All right, so let's keep net interest revenue is a large income driver for Schwab, whose shares have badly underperformed the market this year. The stock is up just 1.2% compared to 16% for the S&P Bank ETF. Other big banks are getting pressured. Officials from Citigroup and Wells said at an industry conference this week they expect lower interest income as well. In the second quarter earnings, Schwab's net interest revenue fell 4% from the first quarter. The company said that in July, if the Fed cuts continued, it expects further decline at the end of the year. All right. While it's never easy to say goodbye to valued colleagues, these actions are a prudent step to ensure we manage our expense growth, the labor cost, while continuing to invest in initiatives that allow us to achieve greater scale and efficiency, like platinum improvements and digital experiences. Labor, man, labor is your biggest cost. That's just a fact. You think these companies, and this is where automation, the robo-advisor thing was a little bit over the top. Everyone was like, oh my goodness, we're all going to be taken over by robo-advisors. That was over the top, but labor's a big cost. They're looking to automate. What are you doing to protect yourself from something like this? Now, hopefully you weren't sitting there at Schwab saying, I'll give it another year before I start really thinking about my business ideas, because now you probably get a severance package for the end of the year, probably stay on their health care for the end of the year. But that's it. And then have you started building your business? Whatever it is, I was talking to a couple of folks last night, they're going to raise some cattle. And she's going to quit her crappy old job at some point to go raise some cattle is what the goal is. We don't know when, where, how, but you got to start that. You got to start it before it's forced on you. And when it's forced on you, desperation, you'd probably be tough to succeed for sure. Anyway, I feel bad for those people at Schwab. I think we're going to see this more and more as net interest income continues to decline. How does that mean for like the Schwab Intelligent Portfolio and whatnot? I tell you, the one thing that these guys, and this is where I'm telling you, this is where the investment industries are making a huge mistake. If we can they're looking at investment management because this is what happened in, was it 2000 and the last time we had this net interest income dropping so much, the wealth management side of these various banks and brokerage houses saved the day. So they think they can go back to that, the two-trick pony essentially, but it's not going to work. It's a one-trick pony where that one trick worked that one time, but it's not going to work again because people are more educated. They're more aware of the fees and the same fees they're paying. So they're trying to build out their wealth management arm to rescue them from this kind of stuff. And the way they do that is by they're going to have assets under management and fees. And you as the end consumer, you got to be wary because they're going to throw the freaking, like the toasters that we used to get back in the day. They're going to throw the kitchen sink at you for you to pay them assets under management fees. And the crazy thing is, it's a dwindling amount of people who have the assets in which to afford that, and B is a dwindling group of people who want to pay that. So it's going to be more and more competitive, and then you're going to have less and less people buying those services, and you're going to have the incumbents in that business who get paid by assets under management. Being like the Fisher guy I told you about the other day. I had an email from a guy that said when he canceled his account to go over to Vanguard, Fisher, the guy he was working with, Fisher, like screamed at him, cussed at him. I was like, that's freaking insane. And it's just going to be more and more competitive. And you're going to start seeing that the competition is good, reduces fees, but these companies are going to have a hard time making ends meet. It'll be interesting to see how this shakes out. So keep your eyes peeled because you don't want to be sitting there holding a wet bag if they all of a sudden throw all these fees that you weren't expecting. All right, we'll see you next time.